Practical Bookkeeping Theory. Brought to you by the Association of Practical Accounts, APA. Welcome to Chapter 9. A General Guide.
Chapter Overview. Section 9.1. Double Entry is on Slide 3. Section 9.2. Narration is on Slide 12. Section 9.3. Duplication is on Slide 17. Section 9.4. Supporting Documents is on Slide 19. Section 9.5. Single Accounts is on Slide 22. Section 9.6. Account Numbering is on Slide 24. Section 9.7. Recording Logic and Copying is on Slide 25. Section 9.8. Completion Marking is on Slide 28. Section 9.9. What is recorded is on Slide 30. Section 9.10. Document Recording Process is on Slide 31. Section 9.11. Verifying Records is on Slide 41. Section 9.12. Vertical Accounts is on Slide 43. We get a general guide just before we start the actual recording.
Section 9.1. Double Entry. In bookkeeping, all values from a document are recorded twice, once on a source account and once on a destination account. The source account is credited, while the destination account is debited.
We credit the giving account and debit the receiving account, and that is when double entry is satisfied. For example, when the owner invests $10,000 cash, their personal capital account, which gave the money, is credited by recording in the credit column, while the cash account, which received the money, is debited by recording in the debit column. Next is an illustration.
On this slide, the capital account is credited with $10,000, while the cash account is debited with $10,000. The account numbers come from the chart of accounts.
When stock is bought using $700 cash, we credit the source account, which is cash, and debit the destination account, which is stock purchases, as illustrated below.
In some cases, double entry is satisfied by more than two entries. We actually transfer from the giving account to the receiving account. This is the reason why we should make a credit entry before a debit entry.
An entry is a recording onto an account that comprises of a date, a narration, the source document's reference number, and the amount in either the debit or credit column. Using vertical accounts, a balance is computed after each entry, in the last column on the right.
The stock purchases account receives the value whenever stock is bought, and the sales account surrenders the value whenever stock is sold. If a business is involved in some form of processing or service provision, then we may use the materials and consumables account instead of stock purchases. Stock purchases account is best if the business just buys and sells.
When a sale is made on 1st July of 2010 for $650 cash, we credit the source, which is the sales account. The debit entry is made on the destination account, which is cash, where the value ends up. Below is the double entry.
On this slide, the sales account is credited with $650, while the cash account is debited with $650.
Section 9.2. Narration. A narration is a summarized explanation for a recorded transaction, aimed at providing some understanding to anybody who looks at the entry on a ledger account. It may not come from a source document. We may have to generate it, basing on provided information, and be able to support it, if asked in the next 6 years.
This slide has the capital account and the cash account.
The capital account is for recording values invested by the owner. The narration says it's cash and not anything else. The cash account is for cash received and paid out. The narration tells us where the received cash came from.
Looking at this illustration, the narration on the cash account says that cash was used to buy stock purchases. The narration on the stock purchases account says that it's cash, which was used to purchase stock.
In summary, a narration provides a summarized explanation about a particular transaction to a business owner, a tax inspector, an auditor, and others.
Section 9.3. Duplication. A source document is recorded only once, and we mark or isolate it using a tick. Recording more than once is illegal, and may be treated as fraud. So a source document supports only one transaction. On a few occasions we have two transactions recorded on different accounts and supported by a single document.
For example, a receipt with stationery and stamps. We debit the stationery and the postage accounts from the same document. If the same information is extracted from the same document more than once, that is duplication, which is illegal. Even if it's at the year end, the same expense or income should not appear in more than one financial year.
Section 9.4. Supporting documents. These are the source documents, where we extract the recorded transactions from. They include receipts, invoices, checks, bank statements, and others.
No transaction is recorded without a source document, as a rule. If an entry is found without a supporting document, then it's disallowed for tax purposes, and it's an imprisonable offense in some countries.
Supporting documents are required for audit and tax investigations. According to the law, they should be stored for 6 years after the end of their financial year. Source documents should be properly filed and referenced for easy searching.
Section 9.5. Single accounts. We have about 131 accounts in the chart of accounts, in the general ledger. Each of them appears only once and none is duplicated.
Therefore, when we create a cash account, it's the only account where we record all cash transactions in the period and financial year. If a page is full, we start another one, as a continuation of the same cash account.
Section 9.6. Account numbering. This refers to the assigning of a number onto each account created in the general ledger, following the chart of accounts numbering. This number is copied when preparing a cumulative trial balance, to ease the preparation of the notes to accounts. For example, the sales account is number 1, while the stock purchases account is number 9.
Section 9.7. Recording logic and copying. Bookkeeping involves the initial part of logical thinking, and the other part which is just copying. Logical thinking involves classifying and filing documents, identifying a transaction, understanding the VAT treatment, generating a narration, identifying the accounts to be affected, and which columns on the particular accounts.
What happens after that is just copying the amounts, the date, and the reference number, as illustrated below.
Errors to do with just copying are not acceptable. An error is the recording of a wrong amount, a wrong date, a wrong reference number, in a wrong column, or on a wrong account.
Section 9.8. Completion marking. We use ticks to mark and isolate documents which are recorded, from those which are not yet recorded, although they remain on the same file. If there is an interruption and this is not done, when we return, we don't know where to start from. So we add a distinctive tick, probably in red, to each source document, immediately after recording it. So the ones without ticks are not yet recorded.
We add a red circled number to purchases and payments documents, for identity and counting, just before recording them. The income and receipts documents have orderly numbers, and all we do is tick what is recorded. This marking is necessary for all bookkeeping procedures since they are many.
Section 9.9. What is recorded? The order of recording follows the numbering. 1. Opening balances. 2. Income and receipts documents. 3. Purchases and payments documents. 4. Wages documents. 5. Banking documents.
Section 9.10. Document recording process. Bookkeeping is a monthly or quarterly process that involves recording information from documents, checking for errors, and ends with the preparation of periodic summary reports. Recording starts after the classification and filing of documents.
This slide illustrates the different recording stages.
During recording we go through the following. 1. Transaction identification, basing on the source document. On the income and receipts file, is it a paid income or credit income earned? If it's a paid income, was it by cash, check, or electronically?
If it's just a receipt and not an income, is it a debtor payment, capital invested, or borrowed money? A cash or paid sale is both an income and a receipt of money. On the purchases and payments file, is it a paid purchase or credit a purchase? If it's a paid purchase, was it by cash, check, electronically, or using personal money?
If it's just a payment and not a purchase, is it borrowed money that was repaid, drawings, or creditor payment? A cash purchase is both a purchase and a payment of money. Identification is required for banking documents as well.
2. Accounts identification. Which account is to be debited, and which one is to be credited? If VAT is involved, is it to the sales VAT account, or purchases VAT account?
3. Narration. This is generated from the source document, at the time of recording. It can be done simultaneously at the time of identifying the transaction.
4. Credit entry. Start with the gross or net amount in the credit column, since it should be accurate to the lowest pence or cent. Next is the narration, and finally copy the date and reference number from the source document.
5. VAT account. For VAT-registered businesses, record on the modified sales and purchases VAT accounts, as we prepare detailed VAT reports.
6. Debit entry. Start with the gross or net amount in the debit column, since it should be accurate to the lowest pence or cent. Next is the narration, and finally copy the date and reference number from the source document.
Section 9.11. Verifying records. We have to verify what is recorded. Verifying is to check and eliminate errors. The instruments are illustrated on the following slide. Each of these instruments is used at different times during the recording cycle, and they are explained in the chapters ahead.
Verification instruments. 1. We have an opening balances journal, to verify opening balances. 2. To verify figures before submitting the VAT return, we have formulas, a pre-VAT trial balance, plus a VAT comparison table. 3. We have bank reconciliation to verify entries on the bank account. 4. We have cash reconciliation to verify the cash balance. 5. We have credit card reconciliation, to verify entries on the credit card account. 6. We have loan reconciliation to verify entries on the loan account. 7. We have a period trial balance, to verify double entry and the balancing in general ledger. 8. We have a periodic trial balance comparison for the less obvious errors in general ledger. 9. We have a cumulative trial balance, to confirm the correct addition of opening balances to period balances. 10. We have the creditor's reconciliation, to confirm the accuracy in the creditor's ledger. 11. We have the individual creditor's reconciliation, to confirm the accuracy against a supplier statement. 12. We have the debtor's reconciliation, To confirm the accuracy in the debtor's ledger. 13. Individual debtors' reconciliation is not common since businesses rarely get statements from debtors.
Section 9.12. Vertical accounts. Most teaching is still done using the horizontal T account, which has a debit and credit side, as illustrated below.
However, with the coming of spreadsheets and software, it has become increasingly important that we get acquainted with vertical accounts, as illustrated below.
The major difference is the duplication of the date, narrations, and document number columns on the horizontal account. The vertical account layout was developed by removing the duplicated columns and adding the balance column.
So we are able to balance the vertical account after each and every entry, while the horizontal account is only balanced at the end of the period. We debit a vertical account by recording the amount in the debit column. We credit the account by recording in the credit column.
Advantages of vertical accounts. 1. We can balance after each and every entry. 2. It enables having a detailed VAT report in the ledger that requires more columns to prepare. 3. The same layout is adopted for Excel and computerized accounts. 4. We can use the same book or columns for ledger accounts, trial balance, profit and loss account, and balance sheet. The end, and thank you for your time. Click close at the bottom right.